My name is Chris and I own this channel Varilla Trading. I've been making videos here since 2019 and I made a video called Do You Need Level 2 Data way back when, and that video still gets views on the channel, believe it or not. Do you need level 2 data in 2025? Let's answer the question right now. Pretty shortly after new investors get into trading and investing, they get prompted by their broker or their charting platform with a message, do you want to subscribe to market data, or you have to subscribe to market data in order to keep using our platform. This is very popular on TradingView. If you're trading live on TradingView or interactive brokers, you actually are forced to get some sort of a market data subscription in order to actually physically place orders on the platform without the platform giving you an annoying message saying, you need to subscribe to market data or else we're giving you this message. And that's the first thing. The second thing is oftentimes traders follow other traders for signals and investment advice. And these traders, some of them use level 2 data. So they recommend it to their clients and they say, okay, you guys need to get the level 2 data. But the thing is, new investors have no idea what this level 2 data shows them, provides them. And for them, it's like a cost that they're not able to justify because the level 2 data, market data subscription does cost money. In stocks, it actually costs quite a bit of money every month. If you're a non-professional, it could cost you upwards of $60 a month extra for all 3 stock exchanges. And for someone who doesn't know what level 2 data is or how to use it, how can they justify spending that money? So let's talk about it right now. This is what you call a price ladder. It shows you at every single price of a market vertically, how many bids there are willing to buy at every price below the current last traded price, as well as how many offers there are willing to sell that market above the current last traded price. That right there is the level 2 data. Another word for level 2 data is market depth data. Another word for it is the order book. Another way of saying it is the liquidity of a marketplace. So how many people are willing to go in and place an advertisement to purchase this market, and how many people are advertising to sell this market or offer this market. With certain markets like futures, let's talk about futures because level 2 data in futures is a little bit easier to understand, and that's actually what you're looking at right here. You're looking at the 10-year treasury note futures. On the buy column, those are all the bids, and on the sell column, those are all the offers. You can see that there's a lot of them, and in the middle, you're actually seeing the current trades going through, and there's not many trades. If you compare that to like a stock or an option like SPY, QQQ, Apple stock, Tesla stock, those stocks tend to trade a lot more volume, or even in, say, cryptocurrencies. Now, the reason why futures are easier to understand for level 2 data is because futures only trade on one centralized exchange, the CME, Chicago Mercantile Exchange. There is only one exchange where this specific futures contract, in this case, it's the 10-year treasury note futures, trades on. Why stocks and cryptocurrencies are way more complex, and options too, is because there's multiple exchange venues with market makers providing quotes. And if you do not have a software platform or brokerage that is able to consolidate all of those quotes on the different exchanges into one data feed where you can read it with your eye, then it's pretty much impossible to see all of the order book for the market. You're basically looking at an imperfect or an incomplete data feed when you're looking at level 2 data for stocks or crypto. So for example, if I go over to my web browser here and I go over to this cryptocurrency exchange, I don't have to name it, but it's a pretty popular exchange. For example, you're looking at Bitcoin trading against US dollar Tether. This is an example of the level 2 right here, or the market depth, or the order book. For every price below the current price, there's a certain amount of people bidding for an amount of Bitcoin. Now, actually, believe it or not, most of these bids here are actually algorithms and bots, but we'll talk about that more in a second here. The bottom line is that there are people bidding for Bitcoin on this exchange at all those prices, and there are other people offering out or trying to sell their Bitcoin at these prices, and you can see that's the quantity of Bitcoin that they're wanting to sell, and that's the price that they want to sell the quantity of Bitcoin at. But the problem with this is that this only represents one cryptocurrency exchange, and most of you guys know that the cryptocurrency blockchain is a very vast network of transactions, and there's probably hundreds of different exchanges where people can bid and offer for a cryptocurrency. So if you're just looking at one crypto exchange, that is not representing the true amount of supply or demand that there might be in that market. One thing people say about level 2 is that the only way it could become useful is if you're actually able to consolidate all the data into one data feed and then read it. Though I personally believe there's another use case for the level 2 data if you have a good quality data feed, and I'll talk to you guys a bit about it more if you keep watching. If you're enjoying the video up until now, press the like button. I really appreciate that because it informs YouTube to send the video to other people looking for this.
If you guys get value out of this content, let me know with a comment down below, and check out Interactive Brokers using the first link down below in the description. And that's an easy way to return the favor if you enjoyed these videos and they help out. Thank you.
Do you need level 2 data? Now let's be a little bit more specific. Let's talk about specific asset classes. Why don't we talk about stocks and options for a minute? Because I know a lot of you guys trade using Interactive Brokers and you guys just want a simple answer. None of this is investment advice. I'm just speaking from my own experience here. Now, I've been trading since 2018, and during the years of 2020 until now, I've been working on pretty much the same system of trading. And at this current point in my trading, I only use the level 2 data for very specific things. And if I had to do without it, I could survive. Though it would pose a bit of a problem sometimes. Let's talk about what that sometimes is. A stock only trades under one ticker symbol. It's always the same stock. You don't have to go in and select the contract or roll over to a contract in the future. No, if you're trading SPY stock or Tesla stock, you're trading that stock. What the level 2 would give you in the case of that stock is, you know, how many bids there are and offers there are on the stock. So if you really want to get a high quality view of the actual amount of bids and offers for a stock, then you can go ahead and subscribe to the market data. However, this is where I don't want to lose you guys. It relates to your trading strategy. If you see the current best bid of the market and the current best offer of the market, and how much is bid and how much is offered at those prices, in my opinion, that's a lot of information already. You're seeing the best bid price and the best offering price, and you're also seeing the rate or the speed at which those prices are changing. And if you're looking at Tesla stock, you can see right here how fast it's moving. So you can see that the bid offer spread, or the best bid offer, is quite volatile. It's moving around a lot. Now, if you accompany that with a time and sales, which in this case is showing the last traded price and how many traded at that price, and obviously what time it's trading, which is right now, because you can see it's trading a lot of volume. If you accompany the time and sales with the last traded price and potentially a chart with your custom proprietary indicators on it, for most retail traders, that's going to be enough information. And the reason why is because most retail traders do not have a considerable amount of impact on the market. If you go in and buy 100 shares of Tesla stock, nothing's going to happen to the market. Nobody is going to care about that order because the minimum quote size, as you can see, is 100 shares on most stocks. I have no level 2 data subscription right now, so all I'm seeing is the best bid and offer and a couple of extra levels there. The minimum quotes are 100 to 200 shares. So if you went in here with 100 share or even 1,000 share order, I highly doubt that that would have any impact on the marketplace. Now, that being said, look at the number of contracts going through on the market right now. You can see we're seeing 100 shares, 10 shares, 20 shares. So if you go in with 1,000, that would actually stick out a little bit. Unless you're trading more volume than what you're seeing on the time and sales, you don't really need to care how many bids or offers there are in the current marketplace other than the best bid and offer. And let me give you another reason why I believe you don't need to care. It's because most of the orders on any order book, especially derivatives. Now I'm going into the land of derivatives, which is options and futures, okay? I would say 80% or more of all of the orders on the order book here, if you watch the order book for yourself, you're gonna see what I'm saying here is true. 80% or more of these orders are just what's called arbitrage orders. They're orders that are placed by market makers because market makers have obligations to provide quotes in the market if they want to keep their job. They have to provide a certain number of quotes every single day to be categorized as a market maker, or else if they're not quoting as much as they need to, then the exchange is going to fire them and hire some other market maker that's willing to provide the quotes. So all these orders are all market maker quotes, and they're arbitrage orders, meaning that they're sitting there waiting to potentially capture a quick inefficiency in the price. Now, they may not be doing exactly what I said there. They may have a lot more sophisticated things going on with their trading strategy as to why their orders are being placed. It's just an oversimplification. Arbitrage refers to capturing a price inefficiency between two exchanges at once. Now, if you just take a minute to look at this order book, you can see how fast the order book is moving and almost no volume is going through in the market. Why is that? Well, it's because all of these orders here are being run by the market makers that work for this exchange. And as the price of the underlying asset, in this case Bitcoin, because these are micro Bitcoin futures, as the fair value of that asset is moving, the market makers on the CME are moving their orders to match the fair value of what the current asset's being traded at on all of the other exchanges combined. Because I would make a bet and say that whoever these market makers are that are creating these quotes on the CME is they have access to the data coming from other sources of where the Bitcoin is actually being traded, where the underlying asset is being traded. And they're using that data to provide the quotes for the derivative, in this case on the CME exchange. And when the value of the underlying asset changes, they're modifying their quotes. If their system of market making picks up that there's an inefficiency in the marketplace, then instead of their order being pulled out, they might actually leave their order there and let it get filled. And that's a case where their system would actually fill the order. Maybe I'm oversimplifying it, but I'm just giving you an idea of how some of these algorithms might be working in the background. Obviously, we'll never get the full details of it because it's proprietary. 80 to 90% of these orders that you're looking at in an order book, when the price gets to that level, those orders are going to disappear. A portion of them will fill. Another portion of them will disappear and pull away. And it'll be as if those orders never even existed. For example, I can place a bid in this market. I'm saying I want to bid. And then I can say, okay, now I want to move my bid down here. Fine. And now I want to move it down here. Actually, I want to move it down here. Actually, I want to move it all the way up here and fill it right now. Or actually, you know what? Screw that. I'm going to cancel it. All of that is perfectly fine. Now, there's obviously limits to it because in the past, people were taking advantage of this and doing what's called spoofing, where they would put in a huge bid much larger than the average amount being quoted in the market. Like, for example, if you looked at this order book, if you went in here and you put in a bid for 100 contracts or 300 or 500, it would stick out like a sore thumb. If you go in and do that and then pull it out and constantly submit it and pull it out, that's called spoofing, because you're, in a way, you're manipulating the market, because you're displaying a level of liquidity on the market that would, in theory, have an impact on the supply and the demand of this marketplace. But because you don't really intend to fill that order and you're messing around with the marketplace, that's actually illegal. It's called spoofing. And if you're doing that in two accounts at the same time, that's even worse. That's called wash trading. But that also brings the question and says, if all of these orders are fake and they pull away as soon as the price gets there, then technically they're also spoof orders. They're also fake orders. And you could probably make the argument and say, yes, that's true. The reality is these are market maker quotes, most of them. And that's just simply how the markets work. I hope you guys are starting to get a bit of a narrative as to how this data could be useful or not useful to your trading strategy. I'll explain to you how I kind of use it. So for stocks and options, I do not find the level 2 data useful in my trading strategy. The only thing that I use it for is determining the level of liquidity that's available in that current market, in the current stock or in the current option. So if it's a really big name stock, most of the time the level 2 data is not very concerning for me. I don't really care how many bids and offers there are, because by the time the price gets there, the level that was bid or offered is going to change. It just gives you like a general idea, but it's not accurate in any way. What you really care about is by the time the price gets there, how much did it actually go through and how many of those bids or offers disappeared? Or maybe there were some hidden orders there that weren't displaying and now the market's stuck at a certain price and it can't get through because there's a big order that it keeps trading against. That's called an iceberg order. The same thing is for an option. If I pull up an option, let's say I'm looking at this Apple February 28th, 250 call. I'm going to go up to account and then subscribe to market data research to show you my current market data subscriptions. These are my market data subscriptions on Interactive Brokers. You can see all I subscribe to is the NASDAQ level 1 and the options data level 1. So everything you're seeing on my quote window here is from those subscriptions. So you can see I pulled up this Apple February 28th 250 call option. That's the price ladder for the option. So you can see I'm seeing the best bid and offer with a couple of extra prices. What this tells me right here, the bid-ask spread for this option is very tight. It's about 2 cents wide, which means if you go in and buy with a market order, you're not giving away a lot of money. Now, definitely go watch my video on why I think market orders are costing traders much more than they know. Go watch it right here. That video is very informational for new investors. What this level 2 is telling me right here is that unless you plan on trading like more than a few hundred contracts, you don't really need to be worried about how many bids or offers there are in this market. You don't. Because the market makers that are quoting the prices on this option, they're using the data coming from the underlying asset to provide their quotes. So if the Apple stock, which is the underlying asset for this option, if the Apple stock all of a sudden experiences a surge in demand or supply, the market makers of this option, depending on how bullish or bearish they are, or if their system is telling them something, they're going to move their orders to be in line with the level of supply and the demand or what they think is going on in the current marketplace. So in other words, if Apple stock's price moves, this option's price is going to instantly reflect that value. As a retail trader, you will not be able to capture that. But the average retail investor is not thinking about that type of strategy most of the time. I would say this is enough information for most investors right here. Unless you control the entire float of the marketplace and you really need to know how likely your big order is going to be to fill or affect the market, then I do not think that level 2 data more than this is going to be very useful for you. So as you can see, I'm not subscribed to level 2 data for options or stocks, and I do not need it. Another reason why I do not need it is because my system of trading and the way I categorize supply demand zones in the market and areas for trading, it really is not dependent on the level 2 in any way at all. So my system doesn't get affected by the level 2. The only thing I really use the level 2 for is gauging the level of liquidity in the marketplace. And also in the case of futures, looking at how the bids and offers are moving, because sometimes this can give you an idea of where the security may be going as you see market makers pull and add orders to the book. Another way that I use the level 2 data on futures specifically is during rollover period. Rollover period for futures is when one futures contract is approaching its expiry date. The traders and investors that are doing business or that were doing business in that contract now have to either accept the settlement or delivery of that contract, which a lot of investors don't do, especially retail investors. We don't accept settlement of futures contracts. And if you're not going to accept the settlement, it means that you need to close your position on the contract that's expiring and open your positions on the next month, or in other words, the back month futures contract. So during rollover period, what I'll typically do is I'll put up the futures contract that is about to expire, and I will also put up the next month futures contract and look at the level of liquidity in both contracts to determine which one I should be trading. And there will be some days where I won't be trading at all because you're just not sure which one it is. And also it could be, based on the level of volatility or how the market is trading, it just may not be suitable. But basically what you need to understand is that during rollover period, you're seeing traders move their positions from the contract that is expiring over to the next month contract. So you might see volume in both at the same time, but generally speaking, you want to be trading the futures contract that has a tighter bid offer spread and with more bids and offers on the order book. The reason for that is because you don't want to get trapped in a trade. You don't want to have to go in and buy your contract and then if you have to sell in an emergency, you're going to sell on a wide bid offer spread, which is going to cost you a few ticks extra. You don't want that. So always trade the market that has the tightest bid offer spread you can find and the most amount of volume actively trading into the market. And sometimes the level 2 in order book combined with the time and sales could give you a reasonable idea of what I just said and how to determine that. At the end of the day, I believe that level 2 data is simply a tool that can assist traders in developing their strategies, potentially doing more case studies in the market to see if certain things work, if they're really curious. I think that it needs to be combined with a broader scope of tools. In my case, my strategy relies more on longer term historical levels that are generated from bigger time frame charts like daily, weekly, monthly, as well as 15 minutes. And I also look at the intraday short-term price action like a 3-minute Heikin-Ashi bar or a 1 minute in some cases. If you guys got value out of this, leave a comment down below. Let me know your thoughts. Let me know how you use level 2 data in your trading. I love hearing what you guys have to say because I know that you guys, some of you guys are really smart. Be sure to click into this playlist right here if you want to learn how to master the Interactive Brokers Trader Workstation software. That playlist right there has some of the best tutorials on YouTube. You can also check out this playlist right here full of Sierra chart tutorials and some add-on software I've written for it. Thank you for watching. See you guys in the next one. Cheers.